Let's go. Right. Hi, everybody. Thank you for joining this latest series of this Product Pulse. Today, we're going to be decoding VC secrets. So we're going to be answering the questions of what investors really want. Now, obviously, what investors want is a return on their investment and some. That goes without saying. But it's more about what do they want? What do they look for in founders? What do they look for in opportunities? What makes a good founder? What makes a bad founder? And what makes an investor actually respond to your cold outreach? And what makes an investor actually invest? So today we're delighted to be joined by Marc Cohen. Marc's a partner at Unbundled VC. He's an AI operator who's now turned investor. Marc, I'm going to let you do a much better introduction of yourself. I know you've got your t-shirt on there, which is one of your success stories. Perhaps you can talk us through a little bit about that. And then I'm going to do a little bit about LogiNet Group and what we do, and then we're going to get right into it.
Cool. So yeah, a long time ago I was a maths undergrad at Cambridge. I went into the financial markets in London. I was an interest rate swap trader at banks for 7 years. And then in 2001, I quit to go do a master's in AI. There was not much around then, but I found a great course at Sussex University in Brighton that turned out to be run by one of Geoffrey Hinton's mentors. Geoffrey Hinton is sort of known as the sort of godfather of modern AI. Met my wife, who was there as well doing her undergrad, so good decision for a number of reasons. Eventually went back into finance, joined a small proprietary trading group, built the systematic trading side of that up to become most of that business. Was doing a side project in poker and AI. We managed with a friend, we managed to build what was then the world's best poker AI. This was all predated DeepMind on a £2,000 home PC, so not quite as much compute, not even as much compute as one of these sort of high demand NVIDIA chips, a tiny fraction of that. Brought that friend into the trading business and we built the fully AI version of that system. Last 8 years of that was living and working from Lugano in the Italian bit of Switzerland, then moved to Guernsey where I am now with my wife and 4 sons. Started doing some angel investing, got brought on as advisor and then partner at a small VC out here, and then sort of left to sort of build Unbundled VC and invest better myself, sort of August, September 22. And then since then, I've been investing in a largely early stage digital tech, pre-seed and seed. And yes, one of the big success stories in that is Runner, which is kind of what it says. It's your sort of personal running coaching app, and sort of without giving away sort of any details, they're growing faster than anything I've really ever seen before. Great founders, and a pleasure to have been able to invest. Sometimes it's one of those ones where there aren't too many lessons to take from it though, because almost everything they did, and look, there's always ups and downs in any business, but like they tried something and it just worked. And so not always so many lessons to draw, usually more lessons to draw from failures than from success. But yeah, that's what I've been doing. And so far there's a few things in the portfolio, including Runner, that are flying. So very happy with how sort of that's been going for me so far.
Okay, well, sometimes it just falls into place, doesn't it? And a lot of people say is that luck can sometimes play a part in these things as well. So, and it just, yeah, like you say, there's lessons in failure as much as there is in success.
And there is a huge amount of luck. I think this is quite an important thing. And I don't that you go and you listen to your like 20 VC podcasts, which I'm sure lots of people listen to, which is kind of the most famous sort of podcast, and they'll interview either a founder of like an exited sort of unicorn business or an early investor in one of those things, and they'll always say why they knew that one was going to succeed, right? And in practice, nobody knew on day one that thing was going to succeed. Everyone's doing their best, trying to make as good, the founders doing their best to pick the right thing to point themselves at and to build that as well as they possibly can, and the investor is doing their best to pick the things that they think they have the best chance of doing that. But nobody knows on day one what those winners and losers are going to be. All you're trying to do is trying to kind of shift that distribution as far across as you can, right? So but there is still then a huge amount of luck involved in terms of what the actual outcomes are.
Yeah, okay. So on that, we're gonna move on. I'm just gonna pretty quickly talk to you about how you can improve your chances of success and mitigate some of those risks. So this event is put on by my company, LogiNet, which is a Hungarian and UK-based product development company. And we specialize in delivering scalable products to the market. So be that apps, e-commerce solutions, software, web platforms. A lot of the things that we do is we have a 12-week MVP program if you're at that stage. So you come to us with an idea and we'll give you an MVP within 12 weeks. And that includes a well-researched, market research product that has UX, UI done, as well as all of the software development. And this is something that you can take to a VC and grow and scale with rather than having to rebuild, and there's a conversation we'll come on to later in terms of, putting together a no code and formulating an idea and proving a concept and then rebuilding and that sort of thing. Well, we try to do it in an affordable way, but also a scalable way. That means that you can build your product and then scale with that product that you've already built, which means that you're reducing your tech debt because you're not having to rebuild. So if you do actually scale and you get some traction, then you can scale faster because you haven't got that lag and lead time of rebuilding the product. So that's a little bit about LogiNet and us and what we do. And, part of what I do and why I put on these events as well is to really help founders understand the why and trying to give back to the founder community. So we're trying to be a partner as much as we can to the founder community, rather than just being a, software development house. Yes, we are that, but we're also trying to add value through our knowledge and understanding what we should build just as much as, how we build it. So that's what we help you with. So if anybody wants to talk to me about that afterwards, obviously feel free to follow up. You've got all of my details probably from the invites and whatnot. So that's LogiNet in an essence. And we put these things on because we want to give back to the founder community. And so that's what we're going to do now. So Mark, we're going to move on now. I'm going to stop sharing my screen so that we can have a bit more of a chat. There we go. Let's talk about at the start really the in investing for dummies, if you don't mind, just really quickly, if we can just talk about the investor landscape and the different stages. We'll make this specifically more about the UK because that's generally where most people are. The different stages, what kind of ticket size that people would generally invest in at those stages, and at what stage your company should be when you approach those people. Does that make sense?
Yeah, I mean, there's quite a lot to that.
There's a lot to that. Yeah, we're trying to sort of simplify as much as possible, and then we'll dive deeper into the more relevant bits.
Yeah, and so I think the first rounds are, which are around the areas where you're talking about sort of building out MVPs, that kind of thing, are, either sort of friends and family rounds or what you would call your pre-seed round. And so friends and family round is typically, the sort of close people that you already know, that you go, okay, I need some money just to get up and going, and typically will be at relatively low valuations. And that there's some certain amount of privilege involved in that as well, because not everyone will have friends and family that can afford to go and do those things. But those are often easier conversations to have with people if it's people that you already know. I'd still say, make sure that those people go in with their eyes wide open, knowing that, this is a risky game. You don't want to lose, if it doesn't work out, you don't want to lose those sort of friends and family at the end of it, or those relationships. But that's often what a first round is. And then at pre-seed, those rounds can be sort of angel rounds, or they can be VC-led rounds. And there are quite a few VCs out there that specialize in that. And of course, there's a lot of SEIS funds out, SEIS and EIS funds out there, and they've increased those sort of allowances last year. So I think in a time when the funding market is more challenging, actually those bits remain supported by all those advantages. In terms of what you actually need is very hard to say. Actually, what you need to have at any particular point, and I think the answer is always the more the better. Because and I'll bring this back in because this is what this is about from the investor's perspective. It's like if you say I'm going to invest in 5 things in the next year, I'm going to invest in 10 things in the next year, what you're trying to do is pick the best 10 of all the things that you see. So it's not a function of if you have XYZ, I'm going to do it. It is kind of you're trying to play a sort of ranking game, if you like, and you don't quite know exactly where that bar is going to fall either. Also, investing is a jigsaw, right? There's multiple pieces to a decision. There's founder strength and all the pieces around that. There's market size, there's founder market fit, there's how competitive is it. So it's never just this one piece is the point where you will just be able to go and get funding. It's always a combination of multiple factors, plus actually where that bar happens to fall, given they're playing a ranking game for each individual investor.
Yeah.
Plus, actually, are you a fit for their thesis for where they say they're going to invest their funds? If they don't invest at pre-seed, for example, and it's a pre-seed round, then like you're just not gonna get anywhere. And round sizes, pre-seed, like fans and family could kind of be anything, I guess. Like pre-seed, I see anything from like, let's say a sort of 250K sort of angel rounds, all the way up to, you can see, and I've been in some of them, like 2 million plus sort of pre-seed
really?
Pre-seed rounds. As well. I think the pre-seed that was a 2 million round, they're probably going to end up skipping seed, right? And so that you sort of have to believe if they're building a larger thing that the opportunity size is big enough.
Is that some kind of deep tech thing or something like that then, I imagine? Or...
No, but it was a great team with a huge market size and potential to grow fast as well. So yeah.
Okay. So let's bring it back a stage, if you don't mind, to that pre-seed where we're talking the 250 range. What, as an investor, do you want to see? What do I need to come to you with to maximize my chances? I'm assuming it's going to be more than just a PowerPoint and a dream and a big smile and whatnot.
Yeah, and look, sometimes it is. So that pre-seed, they've not built anything yet, actually, just to show that those things can happen, because actually there wasn't really anything. That was kind of an all or nothing, which is kind of the opposite of an MVP.
That goes against the narrative these days, doesn't it?
It does. And look, it's not quite, because what you're actually doing is going, well, how can I generate proof points? And at every stage you're like, how can I generate proof points and remove a risk point for me, both for me building the business and for an investor at each stage, right? That's actually what you're trying to do. So I would say it's you are like, and I'm going to talk from the thing we talked about VCs, from professional investors here. You're looking for something with large potential as a venture capital investor, right? The power law is a thing. You get most of your returns from a small subset of the things that you invest in. So you are looking for things that have the opportunities to be sort of unicorns or bigger if everything goes right. Now, the investor knows that most things aren't going to end up looking like that, right? But you want them to have the potential to. If something has the potential to be like 100x, for example, not everything can go right, and you could still get like a 10 or a 20x out of it if it goes quite well. And so this is why investors are looking for those things, because they do end up, the larger outcomes do end up dominating your returns. And then you go, well, okay, how competitive is it? Do they really have something that the market needs, right? And so what you're trying to figure out is like, what's the problem that they're solving for a specific client set? And does that problem, are there any other solutions to that problem? There might be some hacky way people are solving it at the moment, even if there isn't a specific one. And how much do they care about? Are they going to care about that thing? So it might be that they can't solve it at all at the moment, right? Something people can't solve at all. And then you're like, well, do they still care enough that they want to buy it? It might be that they can solve it, but not in a very good way. It can be that it's sold in a very similar way, but at like 10 times the cost. And so actually, this is still going to be, maybe it doesn't quite have all the features, but it's got like 90% of them, and it can be delivered at a much lower price point. And then you go, okay, well, like when you go to your target clients, are they going to care enough that they're going to want to continue the conversation or potentially want to go and buy this thing? So I have to wave my arm every now and again to make the light go
Yeah, the
back on in
light's
my
back
room.
on again. Yeah.
That light's back on. I haven't been moving enough. So it's like, do you have something which your clients are going to care enough about that they're going to want to buy, or at least can start and continue that conversation? And then that client set in aggregate, could that be a big enough opportunity? And then you're also trying to figure out whether the founders are the right people to be building that. But the way I describe it, and this is also the way I would describe you both to present in person or in a pitch deck, is what is the important problem that you are solving for your clients? Important does a lot of work, as in they care enough and the aggregate market size is big enough.
Wow. Yeah, and that's pretty succinctly put at the end there. And so on the actually I should point out before I go on to this my next question, if we're going to be doing a Q&A at the end, if you have
Yep.
questions that arise out of what we're discussing now, feel free to put them into the chat and we'll kind of start a that'll kind of form our list of the Q&A. And if anything are particularly relevant to what Mark's talking about right now, feel free to sort of put them in the chat and we'll see if we can include it in if I spot it. So on that, we'll talk about the founder market fit thing. Can we talk about a few founder red flags, if that's okay? And like what are the don't do's from a founder point of view, or what are things that you see people doing wrong just as much as they do right?
I think one that happens sometimes is actually you need one of the founders to be the person doing the raise generally, rather than an advisor, because one of the skills that is actually important is the ability to sell.
Yeah.
And I get that it's hugely time consuming raising rounds, right? And this is true for everybody. It's a pain. No one really wants to have to do it, right?
No.
And it chews up time when you would much rather be spending on your own business.
Yeah.
But investors are trying to figure out what skill set you've got, and they can't figure out that skill set unless they're actually talking to you in person. And in particular, one of those important skills is the ability to sell, to be able to sell to investors, to be able to like actually sell the product, and to be able to hire the best people as well, because the best people have choices. And actually, if the best people want to come to you rather than somebody else, that's also part of sales skill. So that's one of the things that you see, that is, it's not ideal, right? Because if
So when you say an advisor, like a sort of a third party who kind of like helps you get investment type thing, and
yeah, and look, I
do
think
the
it's fine to have an advisor, but sometimes they want to take the meeting or be in the meeting, or
right.
they're doing the outreach.
Uh-huh.
And I think that's not typically, I mean, there are exceptions, right? But that isn't typically the best of signs. There's probably like 10 other kind of red flag type things as well. They just haven't, that's the first one that immediately popped into my head.
Yeah, no, I see a lot about the kind of the selling things, and I've posted about that from time to time. Actually, is that like I believe that's the number one skill you need to learn, but I actually think that's the number one skill you need to learn. Period, regardless of your career, actually, because you're always selling yourself, no matter what you're doing.
100%. I think it's the thing that people don't really understand. Like when they're at school, they go, "I'm just going to go do this." But if you're like a partner at a law firm, for example, right, your job is to bring in clients,
Yes,
actually,
correct. Yeah,
and keep those clients happy. That is as much of your job as anything else. And
yeah,
how much you get paid or whether you end up making partner depends on your ability to keep
yeah.
bringing in clients. So even, that's the sort of business where you think, well, that's kind of boring and old and not that exciting.
Mm.
But like a huge part of your success, even in industries like that, is can you sell? Can you do business development? Can you bring in clients? Hugely important skill.
Absolutely. And so let's unpack that a little bit more. You mentioned the word outreach, and that's a bit I'd like to touch upon actually, because me as a founder, all right, I'm here. I want to sell my business, well, not sell my business, but sell myself and sell my dream. So how am I conducting my outreach? Does cold still work? And when I know lots of people talk about the networking thing, you've got to go network and you've got to build up your network slowly. And yes, it takes a lot of time. But any tips on that? And how am I going to get my foot in the door? How am I going to get an investor to respond to my email or my request?
So I think warm is always better than cold, but there's no harm in
Mm.
doing cold as long as you're doing it kind of respectfully,
Yeah,
right? And so if you can get a warm intro, obviously that's better. And networking is kind of the way to do that. And it takes time. It's not like click your
it
fingers and you
does.
can just do that. Building up networks and reputation is not an instant thing. But if you do, then you try and get as many warm intros as possible. And if you can't, yes, it's perfectly fine to reach out cold. Most firms will have something on their website. I think it's completely fine to send someone, a LinkedIn connection request and say, hey, I'm going to be raising now or soon. So I just thought I'd connect. You can even and so those kinds of things are all perfectly fine and reasonable, and investors expect them.
Mm.
I think occasionally you get a, hey, I'd like to jump on a call and have a chat, and you kind of know that actually what they want to do is pitch you, and it's like just be honest and upfront and say, hey, look, I'd love to be able to jump on a call and have a chat and talk to you about what I'm doing. Probably what they will do is go, hey, look, I'm busy, I can't spare the time, but here's what my process looks like. Here's the right one to go through. But you lose, as long as you do it again, you do it respectfully, you lose nothing by asking.
That's
And
really interesting. That's interesting because a lot of the stuff is kind of about see, because I do selling, that's part of what I do. And you see a lot of the narrative is around like, oh, you've got to kind of go slow and build up the relationship and kind of have a bit of a back and forth first. And I slightly disagree with that because when I've tried that, people are like, yeah, cool, nice to connect. What do you actually want? And so it's kind of like either you want it or you don't. A little bit is slightly what I believe, and that kind of like, hey, be nice to have a chat, and it's like you know what the chat's about. So do we need to have
yeah,
this dance?
don't come in under false pretenses, I would say, right?
Yeah,
Because that's going to piss people off. I would look, different people will find it different ways of doing it. For me, if ever I have to sell or I do cold outreach, because I have to do cold outreach, sometimes someone I want to go and talk to is say, hey, look, I'd send a connection request, say, hey, I'd love to connect. Um, if you've got time to jump on a call, because this is what I would like to discuss with you, then this. Otherwise, I'd love to connect anyway, right?
anyway,
So
yeah,
they don't feel under pressure, um, and they don't think that's the only reason that you're there. And they might go, hey, they might just connect and then not reply, and that's probably what's more likely to happen realistically. But you've lost nothing because you've done it in like a friendly, nice way. In terms
yeah,
of building up the relationship beforehand, you can do that. It works, but only if you're not raising now, right? Because if you're
yeah.
raising now, it's obvious that that's the elephant in the room. If you're like, hey, I'm going to be starting a raise in like 3 6 months time, if you can spare the time, I'd love to have a chat about what you're doing. And they're still probably going to say no now,
Yeah,
but
yeah.
again, it's how you frame it. And if you do get that conversation, they've built like a connection with you um, ahead of time. People are busy. I think that's the thing always to remember is that if you're busy trying to build your business, they're busy trying to run theirs and do the like million different things that they've got to do as as well. And that's
Mhm.
why. And when you've got money to allocate, and the more money you've got, the more you've got to do, and the more people want your time. And
Yeah, and
so,
I guess that's you
yeah,
shouldn't get offended if you're getting no's or not even no's, just not even a response. It's kind of
yeah,
most of the time it's not personal and
it's
it's
not. And so I think particularly so I'll tell you how I feel on LinkedIn. Sometimes I miss stuff, right? If it's in my inbox in an email, I'm much less likely to miss it.
Yeah.
If it's a LinkedIn message or a connection request, sometimes it just ends up falling down the list and then you forget about it.
Yeah.
And then the other thing I would say is the busier someone is, the harder it is just to reply to everything. It
Yeah.
can be done, but that's why people hire their like executive assistants or virtual assistants or whatever, because if you're trying to hit up someone at A16Z, right, for example, they're going to be getting like, I don't know, like 10 times the number of like inbound requests, or I am 100 times. I don't know. And I know how busy I get. It's almost impossible for someone like that to reply to everything they get. And that looks a bit rude, but it's actually just, I'm not quite sure what the way you can manage, the best way to manage that is just when there's so much volume.
Yeah, and that's not something that AI can solve either, because it needs a human to evaluate these opportunities, I think, as well. So
At some point you just go, am I gonna, like, if you can't reply to everything, you need to figure out which ones. You need filters, basically. The
yeah,
more stuff you have, the more filters that you need. And some people will have someone else doing the filter and going, only look at this subset of emails if they are busy enough.
and actually that comes back slightly to our luck point, because it could be that you just get lucky with your timing, and that
Yep.
the person on the other end just so happens to be doing their filtering at the time that your message comes through, and they go, "Oh, go on then, I'll have a look at you." Just never know.
100%. You catch them when so I was in the States recently trying to meet like other VCs in San Francisco,
Yeah.
and like I had a meeting with like a partner at like running like the $1 billion growth fund at Coastal Ventures, right? Huge fund.
Nice. Yeah.
And I was like, I'm small fry. Why did you meet me?
Yeah.
And like part of it was he played a lot of poker and actually was interested in that stuff.
Uh-huh.
He used to play a lot of poker. Part of it was like I just happened to hit a time when his diary was a bit quieter, right? And
Yeah.
that's just there is luck involved, right?
Yeah.
And so, or that your email popped into his inbox when he was happened to, and I got a warm intro into there anyway, right? But still, when that person made that warm intro, it had to come in at the right time when they weren't like, I'm just deep for a week and then it's dropped so far down the thing that no one's even gonna notice it. There is just luck involved, and there's no
Yeah.
way to get around that.
Yeah. Okay. So we've got some questions on the kind of the founders and and how they're the right people, but I'm going to save those for 10 minutes if that's all right, Phil and Chris, because I just want to talk a little bit about kind of the mechanics of it all. And so I've made my intro and I've got some interest and I've got a pitch and I've got a presentation. Well done. That's a good first step. So at what stage are investors starting to look at numbers and that sort of thing? Do they actually matter at this kind of pre-stage seed stage, or is it all just finger in the air and wishful thinking?
I mean, it's great if you've got some numbers. Often you
Yeah.
won't have anything, right? You won't have any
No.
sales. If you've got some, then wonderful. Um, I mean, again, it's like almost every answer. There's an it depends. Is the short version of it, which I know is like hugely unhelpful to everybody who's listening. If you've got some, then great. Ideally, they're growing fast. Ideally, the unit economics on them look sensible. That doesn't mean you're profitable today, but you're like, okay, I can acquire a customer for this cost, and even though it's only a few, it's this, and my best estimate today, which is going to be like very hard to know, is
Yeah.
that they'll be worth more than that, right? Over time. But a lot of the time you won't have those
No.
at pre-seed. So
So is
and
it
I think
then team
yeah.
and opportunity over numbers, essentially?
Yeah, well, I think what you're trying to do as an investor is trying to figure out, it's like as for me at least, right? And I can't really speak for every single investor. It's like
No.
that word important I use, are you solving an important problem? And it's trying to find a way to figure that out. If you already have like people buying your product and that's growing fast, then I can kind of imply a certain amount of that, right? If you're but otherwise it's like, okay, if you're saying to enterprise, is there some way that I can, let's say I don't know that space because I'm only going to know a few bits and pieces of space as well, is there some way I can validate that actually this is an important problem? right? And that's really what it comes down to, is how can I figure out whether or not this product that you might not have built yet, right? Or you might be, that if you're able to build it, that there will be demand for it, right? And that's what you're just trying to figure out. And numbers is just one way to do that, right?
Okay.
So,
And what would be another way? How can I prove that to you?
so for example,
Assuming
the
let's
one,
say I'm pre-product at this stage, then.
yeah. So like the one I talked about when they raised the 2 million seed round, which is Yasso, which was quite commerce at the time. They're helping Western brands sell via social commerce into China, and social commerce is just insanely big, right? In China, I did a couple of client calls, and it was very clear from those client calls that the standard ways of trying to sell into China, basically everyone, no matter how good your brand was, everyone failed. It was really expensive and everyone failed.
Right.
And everyone kind of knew they needed to go down that other path, the more social commerce type path where we're on WeChat and all those kinds of things.
Sure.
And all the ones that we probably haven't even heard of, but are still huge out there.
Yeah.
But no one knew how to do it. And they're like, if these guys can do this, like, we'll bite their arm off, right? And it was very, very clear that there were enough brands that this would be true of, that there was no good solution to the problem. And if they could really do it, this would be a huge opportunity. And so look, there's more to it than that, obviously, but at the end of the day, you've gone right. You still have to believe they're the right people and that they can actually build the product. But it was like, that was one way to go validate it. Sometimes it's obvious, right? It's something that you just understand. So for example, I invested in a business called Run Yourself, which is a to train your managers to be coaches, and be able to do that at like a sensible price point. Like at the moment, they're charging like £1,000 a year. I think they could probably easily charge twice that. Like basically really good management training or leadership coaches. For example, if you go hire them, the good people are expensive, right? You might pay like 10, 20 grand a year for like a really good leadership coach that you're meeting, because the good ones are just very expensive. And so typically what happens is you can only give them to people like in C-suite and maybe one level below at large organizations, right? Ideally, you would be able to train that all the way down the pyramid, right? And that's like 100 or 1,000 times more people than what's up there. So if you can deliver a service that's quite as good, to me, that was very clear that actually there's an enormous hidden market there if you can produce it at a great price point. And I didn't really have to go and do any research to know that. I just kind of know that there's lots of hidden demand. Everyone would love to have that service if it could be delivered at a sense for all their managers. If you could deliver it at a great price point, you go, well, like if I had to spend, how much better would my manager get if I spent £1,000 or £2,000 a year on them? Like more, a little bit. How much better would they get if they got really high quality like training? Like way better. And so it's just like a complete no-brainer that people would go do that and spend money on it if they can actually deliver it. They've still got to build it and deliver it, right?
Yes.
But it was that one, it was obvious to me that it's not the size of the market today, but I can see the market size would be insanely bigger if they can build what they say they're building. So there are different ways to get there, and every investor will have their own way of getting there. So for Runner, it was like actually how many people, and this was seed rather than pre-seed, but for example, it was, how many people are there that actually run, how many of them do races or like take it a bit more seriously rather than they're just doing it themselves, where they would want some coaching. Plus they were growing very fast, so they'd already built something, so that's kind of the difference between seed and pre-seed. So and had great reviews, and so you could effectively imply the quality of the product and that there was like demand for the product from some of the existing numbers. But that's always what you're trying to get to, is like, could the market be big enough, and can I find a way to believe that actually these people can deliver something that is just so much better or so much cheaper than what's already out there.
Yeah, and actually on that point, before I move it across to the Q&A, is on that, can they build it? what are you looking for at that point? Have these people got a tech partner lined up that you're then sussing out and going, okay, yeah, I believe that these people can deliver it, or because I feel like at these seed stage or like the pre-seed to seed stage, if they're going out and hiring in-house or looking to hire an in-house CTO, which is going to take up quite a large chunk of that cash straight off the bat. That's potentially, I'm not an investor, but that would be a bit like, all right, you're going straight in there for in-house hires. That's costly and could potentially eat up that cash pretty quickly.
Yeah, and it does depend on the size of the round, right? And this is why
Sure.
you need to have, and we talk about round sizing is challenging. You obviously sometimes it's just like I raise as much as I can, but you also need to go, well, if I'm raising pre-seed, what do I need to have delivered by seed, and what's the minimum amount of money that I need to actually go do that, right? And if
Yeah.
you can't raise that, you're probably you're going to make it very hard for yourself. And so it's better to, if you can, wait and try and raise more, because otherwise you're kind of setting yourself up for failure. So there's a few different thoughts on terms of what you go build and whether you need someone in-house. So for example, Y Combinator, who are like the biggest, like most credentialed, like
Mm.
US accelerator, that sort of Airbnb and Coinbase and like a whole, I think Stripe as well, and a whole load of like huge companies went through. They insist on a technical co-founder. They want at
Mm-hmm.
least two founders, and they insist on a technical co-founder so that you can go build in-house. I don't think you have to have a technical co-founder. For example, Runner don't,
Yeah.
but they raise probably bigger rounds than than a chunk of people do. I think you need a founder that ideally a founder that can sort of manage an agile team,
Yeah.
I would say, rather than just and then and I know you guys are a little bit different and you work very closely with the startups you do, but you do hear like horror stories of, oh, we handed this over to someone who said they were going to go build it for us. It came back like 3 months later or 6 months later, um, and it wasn't quite what I was looking for. And they're like, oh, it's going to cost this much more, this much more, this much more, right?
Yeah.
And I think that that happens a lot, and sometimes you can sort of smell that when you're talking to a founder as well, and that can be a bit of a red flag from an
Yeah.
investor
Yeah.
perspective. You want to be working with a group that understands these things, that's built them before, and that is used to working with founders, and that they're sort of being regular sort of feedback back and forth points between them, so that you're going to go get an outcome. And I would say to founders, if you're going to go and use someone, and I'm sure you're the good guys, but like go get some references from people that they've built for before.
Mm.
Even if those people that they built, probably the most interesting ones are the people they built for before, maybe their business didn't make it. Right. And
Yeah.
what you want to hear is it's not because they didn't deliver it,
Yeah.
it's
Yeah.
because uh it's because it just didn't work, but actually they were great, and they built and things came in more or less on price, right?
Yeah.
All these kinds of things. And yeah, maybe this is a good opportunity for you to explain how you work with founders.
Yeah, no, I mean, this is it, and that's part of the sort of the 3 month program, and like I said about how it's not what we do is it's not like we say no to founders, but there's definitely a pushback from what we do, and actually we kind of lose deals sometimes from that kind of thing, because if someone wants like a fixed cost, um, then it's quite difficult to a lot of the time for a founder. It's very tempting to kind of go, well, I've got this person here in X country where they offer cheaper services is offering to do all of it for X amount of money, and you're saying that you can only do half of it for the same money and that sort of thing. And it's yeah, like you say, you do hear these horror stories. But I'm not going to disparage other people's businesses at all. That's not why I'm here. But they do exist, these horror stories, and there's a reason for that. And that's why we're really strict about kind of like what is the minimum thing that we can build to like get you to that next stage, essentially. Because in all of these things, I believe that the momentum is just as important. So when it comes to say your product development, the momentum is important. And if we're shipping stuff in 3 months and then like say we've got release B in 4 months and then we continually iterating the product, that's so much better than sort of waiting 6 which usually tends up to be 12 months, for a product that is kind of half baked and not quite there because you've tried to do too much in one go. So that's sort of, that's the sales bit from me.
And I give you the example of an MVP for like literally for Runner. Their MVP was they built like there was no app. They built like personalized weekly PDFs for people that were out running and realized they could sell those. People were paying like £5 a week or something like that for those. And they're like, and they were selling a lot of them. They're like, okay, there's something here. Let's go build an app.
Right.
Let's go build the real product. So it's about like that thing about proof points. It's like how cheaply can you determine whether or not there's going to be real demand? Ideally, like people would buy the hacky, like you're solving a problem that's good enough, that's a big enough problem that they'll buy the hacky version of your product that kind of only just works and is a bit rough around the edges. And look, there are other things if you're building in regulated industries or you're building for enterprise or whatever, that isn't always the case. But ideally, if you can, because you want to know yourself whether this is working and give yourself a chance, not just, you know, is there really demand here? And it's rarely just, I need one more feature.
Yeah, actually, and it's that's I think I've nicked this one from, I think this one is from the Y Combinator actually. Well, I think it might be the founder of Airbnb, and they were saying that that problem that you're solving has to be so bad. The analogy that he was giving is that your head's on fire, but all I've got is a brick. But I'm going to use a brick anyway because at that moment in time, that's all I've got, but it still kind of does the job to do it. So like, yes, in a perfect world, I'd want some water or a blanket or something like that, but all I've got is a brick. And so that's why I'm going to use that brick to put the fire out. And your product has to be the brick to the fire, as it were.
Yeah, and so those are called hair on fire problems. Not everything is a hair on fire problem, right? So the iPhone, which is obviously like the most incredible product, you know, and sort of revolutionized, brought the whole smartphone era about. No one knew they wanted one of those, but once they had one, they were like, oh my God. And so not everything is quite a hair on fire because no one was like running to get one before they even knew what it was. Well, a little bit because there were lots of people that loved Apple, but you know what, know what I mean. But an Airbnb, just a small sidetrack, but there's another really good example of just that where you go, oh, I'm going to have a big launch, and that matters. Airbnb launched 3 times, and the air stands for it was airbed. It was airbed and breakfast, and you had an airbed in someone's house, like in their living room or something, right? Or you were sleeping on their sofa or whatever, right? I think they famously launched 3 times before they got any traction. So like
they didn't have map view on their product when they launched, by the way. There was no map view, it was just list view, and like it was ugly. Like I love the Airbnb. So all right, I better get some questions.
Sorry.
So we've got some here. We've got a few actually, so we're gonna have to rattle through. This is from Phil McSweeney. Hi Phil. Mark, how do you actually make judgments about whether a founder is the right person? And actually, Chris, as kind of this is a spin-off from that, it would also be great to understand your process of investing to build on Phil's question. So yeah, I think Phil and Chris are both asking similar questions. Is just like, how do you make judgments about whether a founder is the right person? That founder market fit bit, I guess.
So I built a process to go, actually, I want to hear a video pitch first rather than the pitch deck, because I think it's quite hard to pick up founder skills from a pitch deck. But for most people, and that's actually what's most useful, it is you can't get much about whether a founder is good from a pitch deck. You can list some skills out and you can see whether they're capable of building a pitch deck, but that's kind of about it. I think every investor will have a slightly different set of skills they're looking for or different weightings on them. And they can directly ask about them, or they're trying to find them out in conversation. So, I mean, it's not just what you do, it's the way that you talk about what you do. And then founders might people might go take references, for example, from people that they've previously worked with. That does happen. But that typically would happen later on in the process. So
yeah, okay. Actually, just to quickly expand on Phil's question, first-time founders, yes or no?
It doesn't bother me. I'm trying to figure out if they've got the skills or not. And they may be more likely to have the skills if they're like second or third time founders because they've done some of it before. But the underlying principle is, do they have the skills?
Yeah. Okay. Cracking. So from David, I go, hi, David. Got to catch up tomorrow. What's your feeling on valuations at the moment? What does realistic currently look like with a pre-seed VC if you are pre-product, pre-revenue?
It's just too difficult a question to answer. It's such an it depends, right, on how much you raise and how big the opportunity is and the founder strength. I mean, because you look, you'll see like first rounds in like AI things. Just this is just a good example, right? And yes, it's because that stuff is hot, but like what you've got is a space that people will believe will be huge, with great founders. That there aren't many people in the world that can build those things, and a lot of, just to point back at Phil's later question, FOMO, where people go, I just want to get into one of these things and be able to tell my investors that I'm in one of these things. And so uh, there are so many factors that feed into it. It's hard to know. I will say, like, valuation is a tough question. I understand why you're answering it. Even if you see like hundreds of things a year as an investor or more, you're still, to a certain extent, doing this. And for founders, it's super hard. And I think the right way to figure it out is just talk to as many other founders who've been out raising recently or have just raised, and just remember that there's lots of things to it that, you might be able to raise it, even if it looks similar, you might be able to raise at a higher or lower valuation because there's just loads of moving parts plus luck.
Yeah, okay. And actually on that, what typically, like in terms of, let's say we're doing, equity, what typically should I be looking to give away at each stage?
And so people talk about this like 15 to 25% range of things. It's not quite how I think about things, but those are the sorts of ranges that people talk about in terms of like how much you might have to give up in individual rounds.
Hmm.
If you're building in like a capital intensive space, right? So if you're actually building physical products, you can end up or like deep tech sometimes, because they just need a lot of money to
A lot of
get
money.
to thing. Those times often you can see more dilution in each round, but those are
Yeah.
the sorts of typical ranges that people talk about.
And that, at what stage would that be? Sorry,
Like most
most
early
stages,
stages, this sort
most
of
early
15
stages.
to 25% range is what people talk about. In
Yeah,
practice, it's a supply and demand thing.
sure.
So
Yeah. Okay. Oh, we got a few here for Ez. Um, so what are your thoughts on AI wrapper products from investment opportunity perspective?
my favorite question is his question 4,
Okay.
but we'll maybe come back to that. So I don't know who he is, but he definitely knows Guernsey. I
Yeah.
actually kind of live at the moment just between the two of them, for Ez, in Albeck, if he knows Guernsey at all. He obviously knows a little bit about it,
Yeah,
but
clearly.
right between them. That's a sidetrack that's just for me and Ez, that answer. AI wrapper products. So I don't quite know what that
I think it would be like if
means.
you just sort of like build a mobile app that's wrapped around ChatGPT as the API providing the back end, and like you could spin it off as like a health and wellness. I'm assuming this is what you mean, as it would be like a sort of a health and wellness app. Ask me a bunch of questions about health and wellness, but it uses ChatGPT in the background and just basically wraps it. Yeah.
I think they're probably, you might make some money out of them now, but like they're just going to be, it's too easy for people just to go in and go ask the question. If it's anything, it's too easy for them to go in and ask the questions themselves, or effectively you think that GPT-7 or 8, it'll just be able to do it for you. It's going to be hard to build a like sustainable business out of. I think when you're building the sort of application layer on top of these products, which is fine, it needs to have enough of your own kind of,
We'll have
enough sort of
something else.
expertise wrapped into it,
Yeah.
that it's not something that's just going to be directly achievable just by me asking questions to an iteration in like 2 or 3 years time.
Great answer. These are really good questions, by the way, Ez. What is your advice for founders on how to approach defensibility questions during pre-seed rounds?
um that is a good question, and different investors think differently about this. And so ideally you build something, and this is something where founder market fit comes in, that like only you have the expertise to build, right? That, however, that is not what most things look like, right? And the other extreme is someone built Zoom and turned that into an incredible business, which might not quite have the valuation it did during the pandemic, but still like an insanely good business with a very high valuation today,
hmm
which at first glance looked like it was not going to be defensible at all. It just does exactly the same as lots of people give away for free, but we want to charge you money for it, right? But just does it really, really well. And so I think, it's like actually at scale, are there things that I could, but what's nice is maybe it's not so defensible stay, but at scale, there's additional features that I can build into this that will make it hard for someone to come and challenge me. But there is a variation along there, and often there isn't a good answer. Sometimes it's I've built a great brand, right? And it's actually quite hard to build a great brand, but I'm good at that. Which is kind of, and Zoom is a good product, right? But we're using it today, I think, right?
Yes, we are.
But that would have been a difficult question to answer on day one for Zoom. So I mean, I don't think I've really got a good answer for that. Is the short version, Ed? Sorry.
Well, we'll move on to the next one then, which is domain expertise. Is it a must-have for criteria for the founders?
So I think they need to understand their domain, right? Even if they don't come from it, they have to have done the research to go, because you're trying to figure out as an investor, is this a problem that is important, right? It doesn't
Yeah.
quite have to be the hair on fire, although it's lovely if it is. You need to figure that out yourself, right? Before at the point where you're raising, because you need to be able to convince me that it is. And so you don't have to have come out of that space, but you do have to know why you believe that is the case to be able to convince me. So you need some sort of domain expertise. And again, perfect is that, oh, no one else can build this, right? Which is like those AI things, like, oh, I can build LLMs, right? There are very few people in the world that actually could go and build those. And that's an extreme example. Yasso, the selling into social commerce, they had some very specific set of expertise given what they've been doing previously. All the founders spoke a certain amount of I think Mandarin, but they also, it would have been very hard for someone else to go and build that, right? What they were building for a variety of different reasons. So
a lot of it
again,
comes out
yeah,
of sort of problems that a person might have actually personally encountered during their career or in in their personal lives as well, perhaps.
absolutely. And so like when I'm asking, I ask the question, like, I like to hear someone's background and how they got to that point, right?
Yeah.
And then how they found that problem. And it could be in their personal, it could be they just went, sometimes it is, we were just going out, like talking to people looking for a hard problem and they managed to find one, right? But ideally it's one that they understand for some personal reasons. But
Yeah.
it doesn't have to be.
Yeah, okay. Cool. I think that's it on the questions, but I have another one actually that's come off of what you just talked about earlier, which is you mentioned the brand. At what stage does the brand start to become really important? So I'm looking at the runner logo there. I'm going to guess that maybe it did, but maybe the runner logo wasn't like that when they first launched, or maybe it was. But at what stage am I sort of investing in that branding, bringing in as a sexy branding agency to kind of lift the brand up?
Uh, I think you kind of always are building your with or without an agency, you should kind of always trying to build your brand one way or another, be it your personal
Yeah.
brand or your company's brand. And it sort of ties back into that sales piece. So how important is to your business will vary, right? And that will tell you how much time you should dedicate to it.
Yeah.
Like how much difference do you think it makes, right? If you're doing consumer, like runner are, then if people have heard of you or they've seen it a few times, they get familiar with it, it can become important. If you're doing business sales, I don't know, it really varies, right? You've got to figure out for your business how important is that brand, how important is it that you have a nice logo like you do for your business, John, right? And like you go, well, you could probably go and spend a lot of money and make that a bit better, right? There's not that I'm saying it's bad, but there's always, nothing is ever perfect. You've got to
No.
choose where you're going to spend your time. Do you want to go and spend time and money on that rather than something else, like what's important. So for me, when I started doing this myself, I was like, no one knows who I am. I have to just go post on LinkedIn every day and hopefully provide useful, interesting content. Because for me, brand, that was like mission critical.
Yeah.
Because I needed to get deal flow. And when I was setting up on my own, no one knew who I was, right? So I was like, I have to build a brand. When I choose to come and do an event like this, it's for the same reason. It's really important for what I do that people know that I exist and I can get that message out there. And so again, it really is in each case what matters to your business, and that will really vary from business to business. So sorry, it's another it depends.
Yeah, no. It's good. It's good. So we've got a couple more questions that Petra's just put to me from anonymous. Would you put a valuation in your deck or just the amount that you're raising?
I'm seeing fewer valuations in decks now than I was, and that might be like a post 21, 2021, 22 boom type thing.
Sure.
I think nowadays often I'm not seeing them in decks, and I would think that that's probably fine. And going back to the whole valuation being challenging again, there's the problem with valuations is obviously as a founder you want as high a valuation as possible, right? That's just normal and generally sensible. There are a couple of exceptions, but you want it to be start high so you can negotiate down, right? If you have to negotiate down, because it's hard
Yeah.
to negotiate up unless you've got if you have multiple people that want to come and take out your round, that can happen, but it's not so common. The challenge is if you go in too high, that actually it scares people off and they go, well, there's no point even talking to them because the maximum number that I would give them money at is half that. If I liked it, is
Yeah.
half that, and then there's no point me even figuring out if I would like it or not because it's not realistic. And so those are the and it doesn't tell you where you should be raising at, but those are some of the considerations. Just to go back to that point of what's too high is that if you come to your next round and you try and raise, that even if you've done quite well, it's going to be challenging to have like much uplift. And then you end up upsetting your existing investors. They insist on a minimum valuation, and that makes it challenging to raise your next round. So in theory, you want as high a valuation as possible. In practice, that's the constraint. Don't make it so high that it could be challenging to raise at a high enough valuation, high enough uplift next time.
Amazing. Cool. Okay. And we're sort of almost out of time, pretty much are out of time, but we've got one last question that I'd like to cover off so everybody's questions are answered. How many years projections would you suggest? Because figures can be guesstimates even after.
They're all guesstimates, right?
Yeah.
Everyone knows that they're guesstimates and that they're sort of finger in the air. I think it's like sometimes you don't really even have them in there. It's if they're in there, it's a show ambition, but maybe not like don't look like, oh, we're going to be at like 100 million revenue in like 2 years' time. Unless you really, but you do want to show ambition, right? And so actually, if what you're putting in your deck is we're just going to double every year, right? That probably doesn't show enough ambition.
Right. Okay.
And it's that whole like you want to be able to see a path of ambition to that big outcome, even though we know that most of the time that isn't going to happen. If you don't have the ambition to grow fast, it definitely won't happen.
Yeah. Okay. There we go. That's a nice one to end on, actually. Yeah, Mark, if you've got any closing comments for founders, any parting words of wisdom, that'd be fantastic. I mean, I want to thank you for taking the time to join us. There's a lot here actually, and for people still with us, we will send around the recording of this. We'll send around a summary as well, so that all of the key points and takeaways will be in that. And we do this every month, and we have an in-person event in September, details of which we will send out, and we'll have kind of guest speakers at that and investors and founders, a little meetup in town. So that's going to be fun. Thank you, Adrian. Mark, any parting words of wisdom?
I just say, look, I know it's hard work, both building a business and raising money. You go out, there's no guarantee of success, but like without people going out doing that, we'd have nothing to invest in. So thank you and best of luck.
That's a really nice way of putting it. Thanks again, Mark, and thank you to everyone for joining. I hope you got some value from it, and we'll see you in the next one.
Thank you, everyone.
Cheers.